All right, all right. Hello, everyone. I'm Guillaume, and I'm here with Amy Caldoun from the Panoptic research team. This is Beyond the Greeks, research insights from the Panoptic team. Today is a very interesting topic, which is when you sell options, you can choose whatever strategies you want. We compare two delta neutral strategies, Strangles versus Straddles. So, battle of the delta neutral strategies. This is something that is even the same questions can be asked in traditional finance when you sell options. Strangles versus Straddles, they have different trade offs. One pays more and has more risk, the other one pays less risk, but overall, this is kind of something that people can do, and we'll see how it applies to panoptic options. Again, very excited about this. And then, yeah, fresh out of ITCC and Cannes, where I met Amy. But yeah, she's back. How are you doing today, Amy?
Very well, thank you. How about you? Did you
Yeah,
enjoy?
good. Had some
It was
trouble getting out of France. There were these traffic controllers going on strike at the worst
yeah,
possible time. I was able to make it out of Cannes. I think I was the last plane out of the day, so still made it back home. Some delay, but overall was fine. But yeah, I think were you also having trouble with your travels?
yeah. I mean, I did have to take a train. I mean, a flight, but a train, and there were like few problems, few delays. Once you get to the Italian territory, like that's when it started, basically. Which was, I mean, it's pretty much something that's very usual for us. Um, but yeah, it was overall great. We met a lot of interesting people,
Yeah.
and we had
Let
some.
us Let's a fan of the research that we put out too. I met a lot of people that talk about this. Yeah, that's good.
Yeah, likewise. I also met some quants, some researchers, which was really great because usually we don't meet those in events. So it was pretty much
No,
refreshing.
yeah, high quality. I'm glad it's back there. Not because of the beach. I mean, a little bit because of the beach, but also the people. The European markets, I think, they're pretty unique. So it's a different type of people, and then maybe the Twitter hours make it hard to interact. But a lot of folks are in the blockchain doing some pretty cool stuff. So yes, very happy to gone. They've gone. So today, wait, is this it? We'll do the same tree. Is this a yes? No.
Yeah, yeah. Let's not start with a thank you.
Yes, exactly. So
Yeah, thank you for being here,
thank you for being
everybody.
here. This is the presentation that you'll do. We'll start like that, and maybe we'll increase the size of it. Yes, please take it away. The floor is yours.
All right. So hey everybody, hope you are doing well with this summer and welcome back again. In our last session, we explored long volatility strategies. So long straddles and long strangles, and tools that we use when you're expecting explosive moves in the market, but we aren't like sure which direction things will go. So today we're kind of flipping that logic entirely. We're going to dive into short straddles and short strangles, which are two foundational strategies that bet not necessarily on the chaos, just like we did previously, but more on the calm. So these trades thrive in like markets where price action is kind of like muted, for lack of better word.
Maybe
And
sideways markets, which is kind of not a lot of movement up and down.
yeah, exactly. So also sometimes when like volatility is overestimated, and where our underlying asset here in our case the ETH is just like drifting sideways. So before diving into the back test, as always, let's just start with some definitions of our strategies, the short straddle and the short strangle. So let's start with short straddle. So this one involves selling both a call and a put at the same strike price, typically at the money. In the panoptic context, this means that like you're placing your liquidity tightly around the current spot price, and your payoff comes more from collecting streaming fees from like both sides, as long as the price stays close to that strike. So this is delta neutral strategy at entry. You don't care if ETH goes up or down slightly. You just want it to go like not too far. And if ETH remains pinned to the strike, you accumulate fees on both the call and the put leg. So that's like your kind of profit engine. And here, while the max profit is clear and kind of capped, as we can see, so it's the premium that you collect. So the max loss is theoretically also unlimited. So if ETH starts to trend very hard, like in either direction, one side of the straddle becomes extremely costly. And so here, essentially, you're selling something that Guillaume likes a lot, which is the word convexity. And so you make small profits often, but every now and then you kind of face a potential massive loss. So that's like kind of our core trade-off here.
And yes, I like selling convexity. And then really also, if you look at the shape, like the max profit is at one single point, which is quite hard to match. Maybe you're around with your computer, or there's a bot trading for you, but you should not expect to make the most and come back to that maximal profit. The profit target should be a bit different. It's mostly, can you harvest enough fees to make money? And because it's neutral, in reality, it's a bit curved because of the range, but you don't lose much on the price moves. You only kind of make money. And that's going to be what's maybe different between the straddle and the strangle, which you'll see, because now it's almost impossible to get the max profit. You just build into having less than you expect, but at least you have more fees to compensate.
Exactly. And now we can move to the next one, the strangle. So here, for when we look at the short strangle, so here it's a little bit more conservative in design. So in a short strangle, you sell an out the money call and out the money put. So this places the strike range further apart, given the price more like breaching room before you take on losses. And the strategy earns a bit less in premium compared to a straddle, but here your risk zone is kind of wider. So short strangles, they profit steadily if ETH drifts within the broader range that we see on the payoff, and they're more resilient in calm and low volatility conditions. But if it's the same thing, it's the same scenario, that if ETH makes like a big directional move, then breaking through each in either leg, the losses begin kind of to accumulate, just like straddles. So the loss potential is technically unlimited, but the key difference is that strangles require more movement to start losing money, but they also collect less in fees compared to the previous one.
Yeah, it's always about trade-offs. Less risk.
Exactly, always.
You say, I'm going to lose when the price moves more, but you make less. And you can think in terms of Uniswap LP positions. You have two overlapping ranges, and they overlap a little bit maybe, but you have less returns the further away you start from the starting point. But given that payoff, as I mentioned, you should expect to get the max quite more, like it's flatter even. So you could expect to get the max profit between a wider range and not this tiny point, but you
Mhm.
make less. And yeah, all about trade-offs.
Exactly. It's all about that. Like that's the key word for like every strategy, every comparison that we've done so far. So this is the fifth, if I'm not wrong, like the fifth comparison that we're doing, either the fourth or the fifth. I'm starting to lose count. And it's all about trade-off. Like you compare both strategies that are related to each other, either bearish, bullish, or delta neutral. At the end of the day, when you want to like choose the best one, it's just like a trade-off between something that you lose and something that you gain. On the other hand, so yeah, so that's it. Just depends on the profile of the trader at the end of the day. And yeah, so we to test the strategies, we did like just like previously, we ran a full year backtest on the ETH and USDC 30 bps pool from May 2024 to April 2025, just like the previous ones. And we explored how short straddles and strangles performed on the three rebalancing frequencies, so daily, weekly, and monthly. Usually it's just weekly and monthly, but now we add a little bit of spice. We added the daily version, and we would know why. So each rolling frequency gives us like a different insights, as we've seen, into how often you need to reset, or in our case, how often you need to recenter your position to usually to manage risk. And in this process, so we first for the ETH price. So this is the ETH price across the whole year. And here I moved it to, so I did like something else, something more interesting, because I wanted to like see how the price movements are more on a monthly basis, on a daily basis, and also on a weekly basis, by just generating like a series of monthly closing prices monthly or daily or weekly. Then we calculate the month over month or weekly or week over week or day over day percentage change in those prices, which gives us these returns that we see for the three scenarios. So here we can see, like for example, for the monthly, which is more clear because we don't have, so we only have 12 months. We can see that on November we have like a big change, and then sometimes we have like small changes. So that's when you expect to gain more premium, right? Because you don't want the price to move more than it should for either strangle or straddle. And so yeah, here we are expecting, for example, in I don't have a second screen, so I need to zoom in. Uh, the
Yeah,
so
sorry about it.
March, for example.
I cannot move us out of the way. Or maybe we'll
Yeah,
do this.
yeah. So we can just like look at November and maybe the last month, so April, and do a comparison between those two. We will see in the backtest that we have different results. So we can move, unless Guillaume wants to add anything. Okay.
No, that's fine.
Okay. So here we have our
Surprising part
monthly.
is, yes, it seems weird, but a year ago, like not long, we went from 2000 to 4000 back to 25 to 4000 back to 15. It's very, very, if you see this in TradFi, it's almost like a very, very volatile stock. Here it's just any other day in DeFi
Yeah.
or crypto. Yep.
Yeah, so here for under monthly rolling, we saw that short triangles suffered the deepest losses. So we have like drawdowns of up to minus 14%, which pushed the prices, through the out the money wings that we've seen. And while short straddles like also experienced some kind of pain, they actually like perform slightly better on average, which makes sense because they're more expensive, so they have more fees compared to the strangles.
It's not that
And
different though, it seems. The like just the premium, which is the pink one, seems to be a bit lower
uh,
consistently.
so returns are the pink ones.
Oh, I see. So the
Yeah,
premium is the blue part.
yeah, it's the like purple or
Yeah,
blue.
there's definitely a little bit more premium most of the time. You see, like it hovers around 2.5, maybe on the strangle. I mean, which is wider than 5% ish. But yeah,
Yeah.
you get hit by the same moves, which is what you see in the bright green one.
Yeah, and
Yeah.
also interestingly enough, like if we see the last month, so we almost have no PNL, right? Which this is what we want exactly. Like we don't want like a big change in the price, and we can see that the returns doubled from like moving from straddle to strangle. So straddle has like more than 5%, and it's like 6% there. Then we have like 2.5 for strangle.
Yeah, and this is also kind of, I don't know if the math is the same in TradFi, but yes, you do expect to get paid actually quite a lot less. If we do 30 delta, where there's a lot of overlap still, but sometimes in TradFi you can do like 10 delta, 5 delta, and this one pays you almost nothing, but you have a 95% chance of being right. So it's a different trade off.
Yeah.
I would imagine that the 30 delta gets less of those kind of less overlap with the price, and yeah, maybe get a lot less premium as well.
Yeah, exactly. Um, yeah, so we can now move to the weekly one. So here we're switching to weekly rolling. So it gives us like a much more like balance, I would say, between capital efficiency and risk control. So here short straddles again outperform strangles in most periods, while maximum drawdowns uh, remain like more manageable, typically staying under -6% compared to the monthly one. And so here we can say that moving from monthly rolling to weekly rolling just like allows us to realign with the spot price more often, which kind of improves stability, and it helps us also to recover after, especially like after volatility spikes. So so it's typically the same thing, right? It's like on November we have these huge like movements because of, as we've seen like previously on our Ethereum, our price chart. I told you guys, like, remember November. So, for example, remember November. So here we have like a big move in ETH, which makes sense. So it's impacted our backtest, our returns. So we have like a massive breach from our, either for Strangles, so from our point, or like from for Straddle from our point, or Strangle from our little range here that we have on the payoff profile.
And yeah, remember, this was a 40% move in a month, which was very, very violent. And so technically, if you're short the asset, you should expect to lose 40%. And in this case, you only lose 6 to 8%. So this is also where the risk management part of options comes in, because you can now have what looks like a position that earns a lot of fees, but then is more resilient than holding the asset or shorting the asset, which is kind of transforming that 40% loss to 6 to 8%, which is still hurting maybe, but much less than
Yeah.
holding.
Yeah, exactly. And also we can notice like we have much more. So the pink one is our net returns, right? And we can see that we have like more returns than drawdowns, like net positive returns and negative returns overall, and which is what we want at the end of the day, because I mean, we don't want the price to go further. So here, by doing a weekly rolling, we're just like recentering more around the strike price, and it helps us like even increase our win rates that we're gonna see also eventually. I also added that on our. So the more we do these strategies, I mean, the more I do this practicing, the more metrics we find and we include it, and it just like gets richer and richer, richer. I think at some point I would have to stop, otherwise we can just do hours of of live stream, right? So
Yep.
yeah, and we can now move to the daily one, and just like give few seconds. So we can see a huge spike, which is something that we don't necessarily expect in the daily return. So we have like a almost 3%, and even 3% for the straddle. So it's always straddles that outperform here. Like it's theoretically what we want, and it's empirically what we have. So here, obviously, daily rolling is even better than weekly rolling, which is better than monthly rolling. So it makes a huge difference, especially like for straddles. So with that has like tight at the money positioning and frequent recentering. Show strategy, they collect like higher streaming fees and deliver more consistent returns, even like in kind of a choppy markets. Whereas Strangles, on the other hand, like while they're still profitable, they lag behind in premium earned and show slightly higher drawdowns like during these turbulence. So daily here, so all in all, just like daily adjustments help reduce directional risk significantly, and also makes fee collection much smoother across different market phases that we've seen in our yearly chart, like the year chart that we've seen for our underlier, the ETH USDC pool. And unless Guillaume has something else to add.
Oh, that's right. I think the to some extent daily, even you could do hourly, like the quant and the high frequency to do it like minute by minute. So I would expect there's a gain to be made, but yeah, at the end of the day, it's like what you're comfortable
Exactly.
with. Like you also trade off on time, whether you are 24/7 versus once a day or once a week or once a month. Like may change your PNL, but yeah, at least yeah, we can go there. But the win rate seems to be pretty favorable
Yeah.
regardless.
Yeah, so here to get like a clearer picture, so we can look at the performance data across different rolling frequencies. So here, daily rolling produce the highest win rate, about 71% for straddles, 68% for strangles. So, I mean, which is interesting here is that maximum returns was delivered by the monthly rolling. And it kind of makes sense, especially when you have like a very steady month, then you would want to have that position open for the whole month, right? And that's like a pretty much normal thing, because your underlying just keeps, I mean, your underlying stays range, and you just keep collecting premium during that month that's very steady. So it's at the end of the day, it's just like a trade-off. So you just, if you're expecting that you wouldn't have like a very big movements in your underlier asset, then you can just leave it for a week, or you can just leave it for a month. But at the end of the day, as I added here, the daily rolling. So for example, even if we have like an average, so average premium of 0.09%, it compounds to 38% annually, which is pretty much huge. So that is when you don't have any movement for ETH. So when you get the returns, like here, the average return that we had for daily rolling is 0.037%. So here it compounds to 15% yearly, which is not bad, right? It outperforms
Yeah,
the
exactly.
SP 500.
I was gonna say so. There's a. I'll try to load the PDF because this is maybe a. There's a lot going on here, but the one thing that is, uh, yeah, let me see. The one thing that we have to take note is, all right, I'll zoom in.
There's
But
too many things.
no, that's fine. But what we want to see first, the win rate. I personally want to be in a place where I win more than I lose. And if it's 60, 70%, like emotionally, it's a lot better to see making money. And then you maybe have one or two large outliers, but most of the time you make money, which is great. And like this. So then keep in mind, the win rate is one of the best place to be where you can maximize the win rates. Here, there's a lot, but I think the key point is that the returns, if you look at the median, maybe this is 1.8 percent, I guess. But yeah,
Yes.
this is positive return in the median, positive return in the median, positive return. So you have kind of steady win rate, but also positive return every time. And again, if you can manage your risk, and sometimes you cannot, but the drawback is that you lose quite a bit suddenly, but most of them you can recover. So this is kind of the different way to trade. You have lots of small wins, and then you size appropriately depending on the conditions. But you have these total returns, which are mostly positive most of the time, even though the payoff is making you lose the premiums that compensate. So even that uh, gives you some like hope that if you do this for long enough, you'll be expecting a positive EV due to that positive return and then like high win rate.
Yeah, exactly. Yeah, so at the end of the day, I mean, like both strategies, they are bets against volatility. So, like you were saying, I think the market is mispricing movements, or like, oh, I think nothing big is gonna happen. And in DeFi, we have like an implied volatility that is often high, and the market is like hungry for optionality. So these trades can be profitable, until they're not at some point, obviously, because of volatility. So that's why active strike management is critical. So either for rolling, daily rolling, weekly rolling, or monthly rolling. So the more frequently you roll and recenter, theoretically, the more you're protecting yourself from being caught on the wrong side of like a sudden move. But at the end of the day, so it's always about trade-off. So it's all about the a little bit of speculation that you have, that is, I don't know, maybe based on some math and on Twitter sentiment or whatever, and at the same time, your
I
risk profile,
mean,
like how much risk you're willing to take.
exactly. I mean, at the end of the day, like the delta neutral one, you're a bit kind of moving away from being directional. You provide a service, which is I'm gonna put my liquidity on there.
Exactly.
I'm putting myself at risk. If you convince me enough to make money, then yes, I can scale, and this is what I do. And then this is kind of how you should see this: the role of a LP, the role of an option seller, the role of a market maker is to fund the market, taking some risk, but then getting paid for that, so that the users now see liquidity and they trade more. So it's like all about like that trade off, and yeah, the delta neutral kind of encapsulates that view of you provide a service, better get paid for it. If you don't get enough, and I would imagine that different pools and different underlyings may have different returns. But in this one, I'm happy to see that it's at least on the median, net and positive most of the time.
Yeah, exactly. So yeah, to wrap this up, so here the data confirms that what we've seen throughout, like short straddles offer highly max returns. So we are hitting 6.6% for straddles, for 4.3 for strangles, and short strangles are slightly safer thanks to the wider strike spacing, but they also still saw losses as deep as 10%, and for short straddles as deep as 13.6%, all observed monthly. And yeah, and interestingly, both strategies perform best with monthly rebalancing, but it's also interesting to see the win rates when it comes to daily rebalancing, which increase a little bit. So here it means that by recentering, it helps contain risk while maximizing the fee income, which makes short volatility kind of sustainable only with tight active management, basically. So yeah, and that's it for today. Thank you for joining. I mean, there's so much more. Obviously, I'm very happy. Like, if you wanna like comment on our research, if you have any questions, I'm happy to respond and like just have a conversation. I always like to do that on Twitter after the work. And yeah, thanks for joining, and stay tuned for our next session where we bring more backtesting results. Like, it's gonna be our last one for this series, and we're gonna move to other ones that are more interesting, which is not necessarily related to strategies, but more like on the delta side, Greek side, risk management side, quantitative risk management, which is even more interesting. And yeah, see you next time. And
Exactly.
that's it, I think.
Yeah, thanks so much, Amy. And again, at the end, this is a very mechanical back test. Like we don't
Yeah.
even look at anything, we don't manage, and this is kind of the basic level. And as we kind of learn more about this as well, there might be kind of signals that say, okay, you might as well rebalance early if it makes sense, or keep it on if it does. So at the end of the day, looking forward to these. But yes, this is actually a great piece. Straddles versus Strangles, both wins, different kind of risk profile, but at the end of the day, kind of
Yeah, for sure. Also, like, what's interesting here is that not only we're bringing the theory, but we're also bringing its application. And there's nothing like nothing beats the application of theory, because if you're just learning like that, like, oh, this is what it is, and this is theoretically what happens, it just like it doesn't stay in your brain for some reason. So you have to apply it to see the results, and then it just makes sense more. And yeah,
and
that's
then
what we're
you
trying
think
to do to
if you lose
democratize
money
our.
doing something, you'll remember it forever too.
Exactly. Yeah, mostly. That's mostly what happens. You just remember the negative stuff.
That's right. I have no idea about my best trades, but I always see them
Yeah,
over the bad ones. But
yeah,
yeah, I think this is it. A bit like close to 30 minutes, but yeah, this was great. Thanks so much, Amy. We will do the next. Yes, there we go. The next one on Tuesday with Nathan. Otherwise, we'll see you guys on tomorrow with Rosalie. Sees back from Con. And yeah, that's it. Thanks very much, and yeah, have a good day.
yeah.